It's okay to miss the first 50 or 100% rate of return. It's not okay to miss the next 500%. You're never going to get in at the bottom. You're probably never going to get out at the top. But if you can catch some of that run, it can be completely life-changing for your financial picture and for your families as well.
Today we're talking to someone who launched a business, an investing newsletter, leaving behind a career as a financial planner at one of the largest asset management firms in the world. Welcome to Inspired Money, where we explore positive money stories. I'm Andy, your host and financial advisor at Runnymede Capital Management. Let's shift our perspectives on money, get inspired, so we can make a bigger impact in this world. Hit subscribe for Inspired Money channel interviews and money tips. Our guest today is Scott Bennett. He took the entrepreneurial leap, launching the newsletter Invest with Rules. He left behind a more predictable corporate career for the exciting and sometimes daunting life of building his own business. In this episode, you'll learn lessons from a former financial planner, why Scott says we can invest with more confidence by knowing what stocks billion-dollar funds are buying, and important trends that big investors might help us identify earlier. Now let's get inspired with Scott Bennett. Scott, welcome to Inspired Money. I'm so excited to have you on the show.
Andy, it's an absolute pleasure. I really enjoy your podcast, so thanks so much for having me.
Let's jump right in. What's your earliest childhood memory of money?
My earliest and most impactful memory of money, I remember this feeling I had when I was trying to make that really difficult decision as you're a young adult, which college or university to go to. And I had some choices. And I remember talking to my parents, and I remember this kind of feeling that I got as my parents were so incredible and so supportive. And I had this, like, my first memory of, like, I cannot believe how expensive college is. And I remember because I have an older sister, and so they've gone down this path before. And I remember just having this kind of feeling hit over me where I just was really inquisitive. And I said, if you don't like mind me asking, because we don't really talk about money too intimately, are we going to be able to cover it? Is this something we can afford? And I remember my parents they were like, well, absolutely, we'll be able to figure it out. And we came from a kind of a nice middle class family on the East Coast and in Massachusetts, outside Boston. And I remember this feeling of just thinking, that is an absolute ton of money if I went to a private college versus my state school. And I remember my father and I having this conversation around, well, there's a strong likelihood, because he has some retirement money and not that much non-retirement money. Well, maybe he's going to have to touch some of the equity in the home. And I remember this, like, everything was new to me and I didn't know anything. And I remember this, like, I didn't even know what equity in the home was. I didn't know anything. And I just kept asking more and more snowballing questions until it actually became my career, where I just had this thirst for knowledge around finance, and especially personal finance. And I couldn't believe how many people went through a similar process, where this is a memory where I was like, this is my very first memory into money is deeply important and challenging, and sometimes you have to be really creative. And that's really what inspired kind of my thirst to learn more.
Interesting. You have a young family today. How does that get processed into your thinking? Because for me, college savings, the cost of future college tuitions is the specter that is like hiding when I'm walking around, and that's always in the back of my mind.
I couldn't agree more. So my wife, myself, and we have a 21-month-old son. So it's hard not to think about that. We're going to kind of blink and then he's going to be in college and call it 2 decades. So it's one of those things where for years I was a certified financial planner, and I remember seeing all of these traditional paths. So what a lot of people are told, which is really great advice, which is try your absolute best and look out for yourself first. So fill up your 401k, try to put as much as you possibly can, no matter what, do the match. If you can, kind of go for the IRAs, the individual retirement accounts, and fill those up next. And then start kind of what you have left, have your emergency reserves, fill up the college, the 529 education accounts, and you quickly realize that there's not that much left in the paycheck, if any at all. And what I witnessed firsthand is I work with a lot of wealthy individuals when I worked at Fidelity Investments for 16 years. And I witnessed that a lot of retirees went down that path, and they have these really sizable retirement accounts and kind of more or less smaller non-retirement accounts. So I guess what I learned and what I took away from a lot of that is, number one is I have to put a priority on college education, number one. But I also have to save up in a non-retirement fashion too, so that I have flexibility for my family. As an example, I eventually left and started my own business. I wouldn't have had that opportunity if I had to wait till 60 to touch everything, or 59 and a half. But every single time I think about personal finance, the projection of what college is going to cost for Benjamin is incredibly daunting. And I imagine you go through a similar emotion with your children.
Yes, and I have 3 kids. That's why the number is even bigger.
Yeah, I give you a lot of credit. I can barely handle one, so I'm incredibly impressed.
So 16 years at Fidelity, that is a good career. Talk about your experience as a financial planner.
I really enjoyed it. So I started at the bottom at Fidelity and I worked my way up. It was one of those local investor centers that you drive by in kind of the major cities and your nice shopping areas. And I was one of their vice president financial consultants. And really what my job was to create personal relationships with the clients of Fidelity, some of their higher net worth clients. So a lot of them tended to be great savers, doctors, lawyers, business owners. And it was my job to be a sounding board. And it's interesting with Fidelity where they have such a diverse platform of options. So I was able to see such a wide spectrum of clients. So some clients were incredibly self-directed, and they maybe needed me with a question or two per year, not too much. Some clients had their accounts professionally managed or were looking for some more of a hand-holding type of an environment. But I think the real impact was intimately getting to know my clients, finding out their biggest concerns. But I think a lot of money is so embedded in our lives, but it's just trying to make their lives better, protect if God forbid something happened to them, and kind of making sure they don't miss anything. So my job was to ask questions and make sure they didn't miss or kind of misinterpret big risks that they could be possibly inevitably walking into.
It sounds like you worked with a lot of individuals and families over that time. What were your clients doing right versus those who were not doing things so well?
Yeah, well, I worked for most of my career in Colorado. I did work for a period of time in Massachusetts. So different states have different estate tax laws. So I would say that the investors who were doing it right had a documented plan. So meaning that they had something, whether it was formal, it was written, but they had they knew what they were going to do when it came to their investments. So nothing was a dramatic surprise. They had a strategy and they followed their strategy. That would be number one. Number two, it's really hard to think about. It's sad, our ultimate demise, and it's inevitable. We're all going to have to pay an awful lot of taxes, and we're all not going to be here one day. So you have to think about your family and what they need from you if you're not around. And I think a lot of people just candidly avoid it. So when that comes to life insurance, different variations, or that comes to estate planning and different variations, by taking those steps, those who proactively plan put themselves, and in particular their families, in a lot better position. And those who tend to push it and avoid it, that's where the mess happened. And you can see it. It was devastating working with a spouse who unexpectedly lost their loved one, and they had a mess to clean up and they weren't prepared. So by it's not fun, but it's incredibly important. So taking that next step, working with a financial professional that you know, like, and trust, in my opinion, is incredibly paramount to your family's financial future.
So it sounds like the starting that financial plan or starting that process is really key in beginning the communication and the planning if you're not having those conversations already.
I agree. And I think too, obviously we just talked about our children. So having a plan, because I think typically one spouse is what I've witnessed tends to do more of the financial work. Very rare that I saw kind of a total tag team. So I think for any planner that's out there listening, or any spouse or partner that's listening, is to try your best to try to get the other person involved, because the more you have that open communication, and it doesn't need to always be so dry and so difficult, but having that at least annual or semi-annual conversation and having that checklist, I think is just so important, because it could avoid so many pitfalls, as simple as saving early, or just preparing for kind of the importance of financial planning. But those that did plan, and those that did ask the right questions and allowed someone, as an example, like at your firm or Fidelity, they allow those questions to be asked and they're receptive, I think they have a much better path when it comes to their personal wealth.
Yeah, there is a huge importance of having a plan, because there's so much noise and distraction and life gets in the way. So when we have kind of a blueprint to follow, especially during stressful times, you have like a map that you can pull out and say, okay, where are we? And kind of find your bearings. So I definitely agree. But as a financial planner, you were a financial planner. We're sitting on we're on the same team, so to speak. 16 years, you saw a lot of market cycles in different environments. What was the most difficult part of your job?
By far and away, the most unrosy, the most difficult thing that I was ever a part of was the 2008 global financial crisis. And I think back to what we experienced during the 2019, 2020 coronavirus. It was prolonged. And I remember 2008, where when the market starts to kind of cascade down and there's really bigger, significant problems in the global economy, what I witnessed was everyone wants an appointment at the exact same time. So everyone wants to talk about their portfolio. Everyone wants to make sure they're in the right positioning. And for me personally, Fidelity has you work with a lot of clients. And I was doing, call it 5, 6, 7 appointments a day. My phone was ringing off the hook. I had voicemails, emails. It was this kind of, I was bombarded with people that really needed help. And it was emotionally draining and devastating. And I think the hard part is by when the right thing to do for long-term investors is to rebalance and to do the right investing moves for your future. And I think it's really hard, because there is some sort of guttural reaction when the market is causing severe kind of mental, and you see your accounts depleting fast. You just want to bail, you want to get out. And typically that's at the absolute worst time. So as I'm sitting across the table from clients, and I was relatively young, I hadn't experienced as much life experience as most of my clients. So I'm trying to say that the financial rule book says this is what we should be really thinking, this is what we should be doing. But the reality is there's just emotional overload of, I cannot believe how much I've lost this past week or this past month. So for me personally, it was an incredibly challenging experience. I internalized it, and my 401k was down a ton. I had dividend paying stocks that stopped paying dividends. They were down so much. I had growth stocks that got just absolutely slammed. So that started my kind of incredible quest from personal finance into investments, and to say, okay, well, are there other ways? Are there other strategies that exist that could be beneficial that maybe I'm just not aware of? Because I know a lot of these, whenever you get out of the trough, whenever you're past the pain, there's always companies that survive. There's always companies that not only like they survive, but they thrive in these environments. And we saw it during the coronavirus where stay-at-home tech and healthcare boomed during a time when the market really was down quick and down big. So I think the hardest part for any investor, number one, is to go through that experience. And I went through it personally with them. And then to try to think through it and think past it, because the pain goes away. It's typically temporary, and sometimes it's really long, but in most cases, it's usually short-lived. And to try to think about, okay, well, what companies and what strategy will get me through this? And that's what eventually kind of led me to some discoveries for myself that I thought were incredibly interesting.
Is one of the biggest challenges in a financial crisis when the markets are going down precipitously, is it that feeling of helplessness? And were you searching for some way to try to do things better or have like more conviction in your portfolio holdings?
For me, it was. I probably read close to 100 investing books. I became slightly obsessed, but you think back, and for most people, you just need to have a long-term perspective and hold really good companies that you probably utilize personally. But what I did personally was I thought, and I said, okay, well, for most of my retirement accounts, there are no taxes until you eventually take the money out, or if it's kind of a Roth situation, then it's tax-free when it comes out. So why couldn't I take a little bit off the table? So what if there were some sort of kind of indications that it was time to play a little bit more defense with an account that won't punish me tax-wise? So I was starting to kind of question, and I guess I've always kind of done that personally, is just question the status quo and to say, okay, well, we know with, call it 100 years worth of data, that if you invest in an asset allocation, so how much do you have in stocks and bonds and cash over a 100-year period, that on average that it does somewhere between 7 to 10%. And at times you're going to get that average, and many times you'll get over, and there'll be some horrific times where you lose 50%, or call it maybe 30 if you're diversified. So, but I always thought back to, well, what if, I mean, you're really only investing for, call it 30 to 40 years when you're at your max peak capacity of earning potential. And what if you have longevity, that's one thing, but what if you don't have longevity? So your time in the system is incredibly important. What my thesis and my thought process is, well, how can I own what they're buying, and how can I try to let go of what they're selling? So when there is panic and investors like to kind of cash out a little bit from a fund, the fund manager and his or her job is to actually sell some shares in the open market. And what they typically sell are the most liquid names because they're easy to let go. So I started having all these thoughts and kind of epiphanies of, okay, well, what else could I be doing that I'm not doing? And what if my window of investing is maybe not as ideal as the past? So that got me on this path.
Okay, before we continue, Scott, out of 100 books that you've read, what was your favorite one?
My absolute favorite, and I've been a long time kind of not reader, was William O'Neill, How to Make Money in Stocks. And I have always been more of a kind of a growth stock investor. The excitement when you watch Shark Tank, there's kind of that level of excitement of, okay, this company's growing fast. This company is changing the marketplace. I very much learned a lot about, and I love a good growth stock on sale. But typically you have to pay up with whether that be a multiple on earnings or a multiple on sales for a great company. Where a company, like a good example of, I'll take GameStop as an example, a company that kind of got left for dead this past year, and then all of a sudden make this kind of so heavily shorted that no one liked it, and then eventually it became so heavily shorted that people started piling in, and then kind of created this kind of commotion. I'll never forget I had this interaction with a client. He was a professor, really smart client. And I remember he told me he was buying GameStop. This was probably 8 years ago. And I said, well, tell me why. Tell me what's so interesting about GameStop. Have you ever been into one of those stores? Have you ever shopped there? Do they have an online presence? And he said, I'll never forget his quote. He said, it's my Warren Buffett stock. And I was a nice financial planner. So I just politely asked, well, if it's a Warren Buffett stock, why doesn't Warren Buffett own it? So, and he said, the market will one day see its value. And I hope he kept it, because he was right. He was a good 8 years early, but boy, oh boy, was he right. So the number one, I tend to lean, instead of buying something on sale that's my opinion it's on sale and waiting 8 years, I tend to go for more of the growth. So the Investor's Business Daily, the William O'Neill, tends to kind of click more with my personality type.
So you were shaped by reading a lot of books, but while at Fidelity still, you had access to fund managers and tools that many individuals may not have access to. How did that start shaping how you were seeing the markets?
I had incredible access to incredible minds. And Fidelity Management Research globally, but primarily in Boston, has access to incredible companies, research, technology. It's fascinating. The story that really kind of clicked for me and was so pivotal was I was invited to a dinner with a $200 billion fund manager. And it was just us colleagues. And it was absolutely the most amazing internal meeting I had ever been to. And as I'm sitting at this dinner, the manager of the Fidelity Contra funds at the podium, and he's sharing intimate stories. He knows these CEOs personally. He knows their business models intimately. When companies want Fidelity and all of their 401k and mutual funds to invest, they physically fly to Boston. They go into Fidelity headquarters. They have their intimate meetings. And Fidelity asks incredibly challenging questions because they're really long-term shareholders. And I remember as he's telling these fascinating stories, I'll share one where he mentioned the only time I actually really remember a story where Fidelity physically, besides going globally, but went out, was a large majority of the Fidelity team went to Berkshire Hathaway. They went to Omaha to visit Warren Buffett and crew. And the story that, as I'm at this dinner, that just totally stuck out to me was he was able to talk with Warren Buffett and obviously two managers that manage hundreds of billions of dollars. And their conversation was something to the tune of, well, do you have any thoughts on how to manage so much money? I know you've been doing it for forever. And Warren's question was, well, how often do you get an incredible idea? And the incredible is the key word. And he said, well, not all the time. And then Warren's response was, well, when you do, bet big. And we've saw Warren bet really big the last few years on Apple. We've seen Contra bet pretty big on Amazon the last few years. So this last decade has been this Facebook, Amazon, Apple, Google, Netflix storyline. So I'm sitting there in this amazing internal dinner, and I look to my left and I look to my right, and everyone's just kind of scribbling down ticker symbols and notes. And we don't totally know if he's buying, but he's sharing, this is interesting. I'm researching several food delivery services. I don't know who will be the winner yet, but they're really interesting. So he has all these themes and all these stories, and we're all just on the edge of our seat, just totally enthralled. And I sat back and I remember thinking to myself, how do I know if he's buying? How do I know if he's consistently buying? What if I could figure out where most of his capital recently is heading, and if I could avoid what his capital's leaving? And I thought to myself, well, what if I could do this for a lot of other funds that were similar size? And what if they happened to buy the same stocks? So that was kind of how my investment newsletter, Invest with Rules, was created, because I discovered a way to figure out with a very ethical and legal way to help self-directed investors who manage their own money or part of their own money to identify stocks that large money is aiming at. So whether it be hedge funds, mutual funds, family office, trusts, banks, a lot of this information is out there. And what I want to make sure I do is filter it and kind of give the themes of what large money is up to and what they're getting rid of. And then for members within my program, then I give the stocks. So this is this like, I cannot believe how incredible their research staff is. And what if I could just, as much as I think some days I'm on it and I've totally got a good idea of what's going on, they're modeling, their research, their access is so superior. So why don't I just use their best ideas?
So inspired by this dinner and hearing the Contra Fund portfolio manager speak, you go back home. What's your next step? What is it that you start looking at?
Yeah, so what I started doing, so the first thing I do, which a lot of people do, is you look at what's called a 13F report. So from the SEC, if anyone who manages over $100 million needs to show their cards every quarter. So this information is widely public. There are some websites out there that publish it as well. So the first thing people do is you'll go after these 13F reports. And what tends to happen is you realize that you're a little late. So if we just use the calendar year really simply, so when a large fund between January and March 31st has March 31st, they simply take a snapshot of the holdings. So you see the picture of everything that they actually hold. You don't know if they bought or sold at this point. And then they wait 45 days and then release that to the public. And that's one way to kind of keep transparency in the industry and try our best to not have huge blowups and huge scary things happen, but that still unfortunately happens. So the only way to do it is what people do is they go back to the previous quarter and you compare. And I think what's really interesting is you realize that you're a little late. So I started going through that path. I, like most people, looked at kind of insider buying, and sometimes it tells a story and sometimes it doesn't. But insiders of a corporate stock can sell for dozens of reasons. As we mentioned earlier, pay for college is a really good one. So, and they're usually on a schedule when they do sell. So they have a systematic selling procedure. But typically, when an insider buys, that's usually because they like what's going on. Now, they may or may not can share that, and they have windows when they can buy or not buy. So typically, an insider is really rapid information, and a 10% shareholder in a corporation is really rapid information. But what I was trying to figure out was, how can I get a lot more of this data, a lot more of this information faster? And obviously, I'm not immediate because I have no desire to have any financial or legal issues. So there's no insider trading. But I was able to figure out a way how to scrape the data, kind of cut it, clean it, and look for consistency of buying, look for share increases. So I want to see accumulation, and I want to see kind of a voracious appetite for shares. And I really want to see market capitalization. So how big the company is. I want to see an impact. So when I look at a kind of a month-to-month trajectory of what's going on, I want to see companies that have huge desire, that companies they're going to look at these companies and say, okay, over the next 3 to 5 years, we need to own this company. And that's what I would like to own as well. So that's what I'm after. And I'll never forget this other quote from William Danoff of the Contra Fund. He said, it's okay to miss the first 50 or 100% rate of return. It's not okay to miss the next 500%. So you're never going to get in at the bottom. You're probably never going to get out at the top. But if you can catch some of that run, it can be completely life-changing for your financial picture and for your families as well. So by having exposure to some of the life-changing companies that are right before our eyes, you just need to have a piece of it.
Okay, so I think with stock investing, a lot of people are kind of tempted by the water cooler discussion about some long shot company that, I don't know, they're going to have some miracle cure for cancer, or, something that's like people see like is disruptive, but probably super high risk. And I think oftentimes as retail investors, you kind of get sucked into, oh, I look, this stock is selling under $10, I can buy it. And if it goes up to 20, I can double my money. It's got this story, but all too often those stories don't pan out. It was too high risk. You're kind of trying to avoid that. You're trying to say, if I can identify what the biggest funds are buying and accumulating over time, the smart money who has a team of analysts doing great fundamental research, they have a lot of funds, a lot of resources, and they're allocating enough capital that they're not going to be able to buy it in one day. You're trying to access that expertise and trying to ride a wave, it sounds like, that could be sustainable. So this is like a great idea generation story, right? You're trying to isolate, you're trying to identify trends and names that are being bought by, I don't know, a couple dozen funds or family offices.
It's exactly right.
Is that how it works?
It's exactly how it works. So I will admit, when I first started investing, I had that same itch that a lot of people have, which is go after a low price stock, try to buy lots of shares. And what you quickly realize is that large funds can't get in. They're too small. And then when you want to get out, because you've accumulated so many shares, it's really hard. You actually hurt the price on yourself. It's the exact same thing for large funds. What the goal is they have billions of dollars. And collectively, this is a multi-trillion-dollar industry. So they can't buy in all in 1 month. They have to chip in, and they have to buy slowly. They have a tidal wave of money. And they also, when they sell, they're going to have to get out slowly. So there are some very large liquid names where they can push around a couple $100 million pretty fast, but that's only a few names. So what most investors realize is that even though you'd love to own a hot biotech or a hot penny stock, most of the time it never works out for you. And the simple reason is that large money is what's moving the market. So institutional, large, huge dollars can't go after those teeny tiny kind of $100 million companies. They need to go after multi-billion dollar valuation stocks because they want to create a sizable position and have an impact in their portfolio. So the way I think about my process with Invest with Rules is just simply, I think a lot of self-directed investors click around a lot on websites, and I adore the fiduciary rule. It should have been there years ago. But I do believe now with the fiduciary rule, there's a little bit of a wall for the self-directed investor, meaning that if they want help, they get the fiduciary experience. And if they don't want help, meaning they want to manage some or all on their own, they are kind of led to a website that has research that's typically old data, and it doesn't relay that much confidence. So what I have personally found is, as they kind of start to get going on the computer, they're like, okay, well, maybe this is a good company. Maybe I should invest a little bit. And they start to kind of hit these roadblocks is what I found. And a lot of these roadblocks they're lacking this confidence. But what I have found personally for myself is, if I know that dozens of billion-dollar funds are slowly accumulating a particular company, I have significantly more confidence to hold it in good times and bad. And I think the other thing that every investor should do is to have some understanding of position sizing. And that simply means how much does this particular stock weight in your overall portfolio if you are self-directed, or if your overall net worth, and think backwards. So meaning, let's take like a 1% rule. So I personally don't want to lose more than 1% on one investment. So let's take a really round number and say, okay, let's say you have a $100,000 portfolio, you position size at 3%. Some people position size way higher, some people position size way smaller. But if it's a $3,000 position, you lose a third, that's $1,000. So there's your 1%. So you have to have some mechanism to understand your baseline risk, because as much as everything sounds so golden and simple, the reality is anything can happen. A coronavirus outbreak can happen, and even the smartest group of fund managers, they can be wrong over a short period of time. So it's really important to manage your risk, and that's why there's some rules that I abide by. But number one is buy what they're buying, and number two is sell what they're selling. But you have to manage the bottom line, because it's not worth it to risk too much and hurt your family's financial future, even if you think you have the world's best idea.
Scott, devil's advocate question for you. Why is it better to try to look and study at what the contra fund is buying and selling versus just owning the contra fund?
That's a really good question. So I would say if you don't have the time or the energy, I think if you hold a mutual fund over years and decades, you'll be financially rewarded. The hard part is a lot of actively run funds have higher turnover, which simply means they trade a lot. So they're better held in a retirement account. If you hold them in a non-retirement account, what I witnessed a lot of clients go through is that they love the fund, they love the fund manager, they love the story, but every year they're kind of hit with a large capital gain in a distribution tax that they don't necessarily want. So if you don't have the time or the inclination, I think owning a great manager is a great decision. But where I come in and where I think my strategy is really good for those that want to take a little bit of initiative is a couple fold. Number one, let's take like an average. So let's say that there's 300 positions in a large mutual fund, and 100 stocks they're buying, 100 stocks they're holding, and 100 stocks they're selling. I want the 100 they're buying. So I want to kind of shift towards the 100 they're buying. I want the control over the taxes. I want the control over which names that I want in my portfolio. And what I've witnessed a lot, it's an interesting analogy. It's think of yourself as kind of stuck in traffic on the highway. And let's say we're in the middle lane, and then all of a sudden we're in standstill traffic. It's a total like nightmare. You're late. And then all of a sudden the right lane starts moving. And there's this kind of click in the back of your mind saying, maybe I should switch lanes. The right lane seems to be moving better than the middle lane. And what happens is the second you move over to the right lane and you're now stuck in the right lane and the middle lane starts moving. If you just follow one manager or one guru, what tends to happen is there's something, again, human with the way we all act, is you'll drop the fund at the worst time. So when the manager has a tough spell because of the stocks they hold, then there's a higher probability you're going to sell it when they haven't done well versus sell it when they're on a hot streak. So by cutting through dozens upon dozens of funds, we're avoiding the one guru issue of you getting rid of the greatest fund of all time at the worst possible time. So by cutting through the best managers, going after the 100 stocks that they're buying, whittling that down to about 25 names to get the best watch list, in my opinion, for a self-directed investor, if you have the inertia and you enjoy it, I think you'll be successful.
So you're telling me don't switch lanes, because as soon as I switch lanes, the other side's going to start flowing. Everybody can relate to that.
I tried my best at Fidelity to challenge thought process. And I would always say something, can I politely challenge your line of thinking? I'm not challenging you as a person or your intelligence, but it's just, we're human and we don't want to be in the slow lane. No one does. And I think and it's really hard to let go of the winning fund at the high, but that's the beauty of long-term and rebalancing, is they're going to get cold. So that's why professional managers, that's why a strong process rebalances, because it's going to happen at some point.
I'm going to assume that you leaving your job of 16 years, that reflects that you saw tremendous value in the data that you were following, and that's why you launched a investment newsletter. So just for everybody's information, Invest with the Rules is free to sign up for. You cover themes there, and then you're selling the buy list or the specific ideas. Is that how it works?
Yeah, so at investwithrules.com. So what I do every week is I deliver for free. So I want you to see value, kind of test me out. And what I do is I deliver kind of a trend idea or a theme when I cut through all the data. Recently, we've had this really interesting market environment where tech has not done as well. So technology stocks have underperformed, while sectors that are more inflation related, economic growth related, like financials and energy and materials, have all of a sudden done really well. And maybe there's a million storylines you could apply. You could say, okay, well, there's maybe an infrastructure bill coming, or there's all these storylines that will try to trick us. But the hardened data is large funds were shifting and kind of taking profits in tech, and they're moving into some of these more inflationary names. So when every single week I deliver kind of an idea or a theme. Sometimes I'll kind of tie it to an indexed fund like an ETF, or tailor it to a stock if it's applicable. And then what I also do is I kind of give more of a general trend analysis of the US market, the foreign market, the bond market, and the gold market, because I think it's important to kind of, when you're getting these feelings of should I bail, I really feel it's my responsibility to kind of give you a second set of eyes to say, as much as everything in your bones says sell, like you're probably at the wrong time. So by having a second level of kind of a thought process, I have a trend model that's more longer term in nature. It does give you warning signs when, as an example, back in March and February of 2020, it gives you warning signs when there actually really are problems. But most of the time, it will just kind of keep you on the right side of the trend. So every week I deliver that for free. And for those that are interested in more, I do have what's called an Inner Circle membership, where very simply I do give the names of the stocks from all of my data and research. So more research. I try to save you time by simply just giving you those names. And my hope is that we find stocks like this previous month. Obviously, not all will be winners. It's just how life works. But collectively, we'll find some great ones. But there was one consumer lending stock that happened to be a high flyer. So the hope is we're heading to where the funds want to be in the future.
Scott, how do you think the pandemic impacted the market and the themes that you've seen over the last 12 plus months? Because I feel like this is an environment like none other that we've ever seen before. We've never seen entire sectors of the S&P 500, for example, locked down, not operating. Retail was shut down, restaurants were shut down, travel was out. We've never seen that before. And I think that the data that you follow kind of gave you a little bit of a heads up on what was the smart money doing? Can you give us some insight into what that looked like?
Yeah, it's so interesting. So the way I think of it is, if you just look at it from a 1 month perspective, it's hard to tell. But when you start to see month after month of buying and selling activity, it absolutely tells a story. And I've been looking at it long enough where I'm able to kind of think through what I think they're thinking about. So as an example, we at the end of 2019, the CDC kind of gave some indication that there's some unknown pneumonia virus that was overseas. And right about the January timeframe, they called it COVID-19. They kind of named it, and it started to become on people's radars. It started to hit the news. And then at the end of February, that's when the market really took a hit. So what I was seeing, because I'm looking 30 days behind on looking at data, and not much was really decipherable in December. But then all of a sudden in January, I started to see, when I start to see kind of large kind of gutting of positions, I sit forward. So things that I noticed were airlines, energy, banks, large, kind of very sensitive areas were just being sold very, very hard. And at the very first month, I was like, well, that's really interesting. I wonder what's going on. Maybe my question in my head is maybe some of these fund managers think this is going to be worse than what the news is telling us at the moment. So I started to see a couple of kind of more of the money started flowing into large cap tech. It started flowing into the stay-at-home tech, the healthcare space. And you're like, I wonder, maybe they're betting on Moderna, maybe they're betting on Regeneron, maybe that's where they think the vaccine may come from if this really does get out of hand. Then we pulled towards February. Now it's very clear to me, energy's out the window, banks are out the window, airlines, restaurants, anything physical, they're unloading. And that's when you start to see February kind of the market just kind of peel off the side of a table and it kind of this crescendo of selling. And more stay-at-home tech, more healthcare. And I start to create these theses in my mind of, okay, well, this is really, really serious. And as I progressed, the same story happened where most of their positions were gone. And then what was really interesting is the way that the data gets confusing for most of the public is, again, 45 days at the end of the quarter. So that's May. So what's really interesting is May was when you heard that Warren Buffett sold his airlines, but you knew he sold at some point between January and March. You just don't know when because that's 13F and it's really old data. So what I started to see starting in May were large funds started to accumulate shares of stocks that were down half, 60%, 80%. That's when there's some managers that are, these men and women are so bright, but they're kind of cowboys and cowgirls where they start to buy airlines, hotels, things that you couldn't fathom that we would do personally. So the thought of going to the mall, the thought of getting on an airplane, the thought of having someone in the middle seat is just like you get the chills thinking about it during the heart of the coronavirus as we're washing our groceries as we bring them home. That's when they're accumulating. They start accumulating when no one wants them. The blood in the streets, the Warren Buffett famous quote. So I start to see a picture. And so I share these themes. And for me, I think everything's just so easy just to say the system doesn't work or life will be different forever. And we now know that life's getting back on track. And now what I definitely see as a clear theme still is the reopening story. Still a very big theme that the funds are getting involved in. Still very interested in banks. So if interest rates keep going up, granted they're still really low, but the people who are going to benefit are those that are giving the loans. Those you're going to get more interest on your cash and the banks make more interest on you. So the financials, the energies, as the world is slowly coming back online, what are they selling to get after those names? Is they're selling some of the large cap tech. I mean, when a stock like Tesla goes up 700%, it is prudent to take some off the table. And that's what they do. They're prudent investors. They realize when valuations get extended. And I just look at their buying patterns and their selling patterns.
Scott, with the 13F, that's usually quarter end. They have 45 days. I think most are filing that later rather than earlier, right? Do you have other data sources that you're looking at in addition to the 13Fs that give you more timely insight?
I do. So I have uncovered lots of other areas to kind of collect data. So that's something that I do, and that's my day job. So I do. So there's an awful lot of other places to find data. And my job is to kind of make sure it's valid, to really cut through it and to try to give those names out quicker. So I am about 30 days behind with my data, so it's not immediate. But I think having that data plus other confirmation sources. So a lot of examples of really confirmation sources for me would be 13F reports, insider buying. There are a growing number of actively run ETFs that have to report every single day. So these are the types of confirmation sources that help me solidify that I'm on the right track.
Yeah, super interesting and really cool to see some of those shifts taking place and kind of ahead of the curve, right? I'm sure that you see things that are not on the like headlines of CNBC, and then you kind of get confirmation later on. You say, well, this is what I've been seeing for like the previous couple of months. You're ahead of it.
It does give you that level of excitement sometimes, that you find out this kind of disruptive technology maybe before other people. So obviously the goal is to try to make money and avoid some devastating losses, but also it does make me and some of the readers slightly more intelligent, because you have a little bit more fun water cooler conversations, because you're learning about areas of the market that are fascinating, that are kind of game changing, and where companies, I'll take last week's example. I think what happens is, for most companies, that you need to retain your clients as best as you can, and the number one way to do that is to listen to them first and wow them second. So when I think about customer experience technology, what a lot of the time, and I'm guilty too, is we ask our clients, would you be likely to refer me or refer a company? And you have to answer this strange 1 through 10 question. And I used to get scored on that by Fidelity all the time. That survey is really important, because referring someone, for some people, it's like a no way. They don't refer anybody. But if you refer someone, you really like the experience. But there's actually technology out there now where it not only tracks the data, but it tracks all conversations in every social loop that can touch a company. And in today's world, as we're moving, AI, so this intelligence, this fast-moving data, it is so important to retain your clients and to understand them better. And this world is just simply moving in a direction of more data, and who has the best data and who can decipher the best data is going to win. And most of them will win on their own. If they don't win, they'll get kind of gobbled up by a large company that needs that piece of the story. So I just think that there's so many interesting and fascinating areas of healthcare that's kind of slightly beaten up right now. There's interesting parts of where our energy infrastructure is kind of moving more green. In the past, we'd always talk about green because it felt good, but now green investing is really lucrative. So it's the right thing, and it's the right time. So there's all these really interesting themes that come up that are just generally interesting, and it makes investing, for me, a whole lot more fun.
And how do you charge for the inner circle?
Yeah, so right now, I mean, granted, I've been doing this for myself for so long, and I thought, I do this research anyway. So right now, I invite people who are interested in quarterly. I charge an annual membership. I've been keeping that, as of right now, it's a very moderate amount per month. I try to just, what I really want to do is get as many people in that want to experience that list and learn from them, and then make my solution better and more impactful. So it's all relatively new for me. My hope is that you start with the free investwithrules.com, kind of get a flavor of what it is, see if you even like it. And then from there, if you do want the names of the stocks before everyone else, then that's where the inner circle comes in. I'd love to have you join me. But in general, it's I try to make it so it's incredibly affordable.
And how scary was it leaving Fidelity to strike it out on your own with this newsletter?
Incredibly scary. I thank you and your podcast and great voices and great names who have come before me. I think anyone who's worked in a corporate environment for so long, and I mean, granted, there are so many people at Fidelity who've been there for 20, 30, 40 years, and I was approaching 20, but all those decisions were made for me. So you just walk in, you turn on your computer, and you pick up the phone, and you try to wow and delight clients. And your job, when the day's done, it's over. When the weekend's there, it's off. You take vacation. You don't think someone else kind of covers you. starting a business is really amazing and really daunting at the same time, where you need to make every single decision. You really want to make people happy. And I think in general, what you also want to do is make yourself and your family happy too. So it's a delicate balance, but I think striking it out on your own is hard. That's why not everyone does it, but my hope is that it will be a rewarding journey.
And Scott, I like to ask all the Inspired Money guests, how do you define success?
I define success, I'll go professionally. I really want my readers of Invest with Rules to feel that they've learned something, to feel inspired about their own personal wealth and some of the storylines that are going on investing around them. For the Inner Circle members, I really want to get them results. So I really want to deliver and help them make money and avoid devastating losses. That's really important to me. For me personally, for my wife and my son, I really want to have great quality time, be totally present, be kind of physically active and be healthy for them. So success is just being present and available for readers, subscribers, or members, and for my family. That's really important to me.
And you mentioned at the start of our conversation that you had put money aside that allowed you to start your own business. How far in advance did you have to start doing that? Were you planning to create your own business? How did that kind of play out?
I wasn't. It's really interesting is unfortunately my mother got really sick and passed away last year from metastasized lung cancer, and she was sick for 5 years, and so for about 5 years before, I learned that there's a chance that my gene pool isn't great, and what it really hit me over the head is time is limited, and I need to make the most of it. And for me, the way I internalized it was, instead of maxing out my 401k, which was something that I always kind of mentally strived for, I just did up to the match. And then I filled up my Roth IRA. And then I just, for some reason, had this urge to, what if I don't spend a lot of money? What if I live pretty modestly? What if I was able to retire potentially, if I played all my cards right and I invested really well, what if I could retire before 59 and a half? I didn't want to get to a point where I had to wait to access the money or have penalties. So for me personally, I waited 5 years, and the precipice for me, like a lot of things in people's lives, is a traumatic moment, unfortunately, where missing her is terrible. But what the lesson I learned is flexibility is so important, and the unknown is so important. So for me, starting a non-retirement account that gives me flexibility happened to allow me to give me room to breathe when I left, and then kind of a runway of time to hopefully have a successful business and help clients out.
Well, thank you for sharing that. I'm sorry to hear about your mom, but it is nice hearing that part of her legacy may be you making changes in your life toward like a life better lived.
That is the absolute hope. And I think, podcasts like yours, you have inspiring guests, you tell inspiring stories about money. And I think it's so easy to be busy, but if on a dog walk or while you're kind of maybe not totally multitasking, but to listen to a great podcast that tells great stories that can encourage you to live your best life is just so important. And I hope everyone does the best for themselves that they can and supports their families and does things the right way financially for them.
Well, thank you for listening and for coming on the show to share your story and all the exciting things that you're doing. The, I think, very unique research that you're doing to build your own wealth and then also benefit others through the newsletter. Tell everyone where they can follow you and find out more.
Yeah, thank you. Again, thank you for having me. The absolute best place is investwithrules.com. Again, Scott Bennett with investwithrules.com. Sign up. I hope you love it. And it's something that will arrive in your email box once a week.
Thanks so much, Scott.
It's a pleasure. Thank you.
So what was your favorite Inspired Money moment? trying to look out for yourself first. I really like that advice. Fill up your 401k, definitely take your match, go for your IRAs next, fill those up, fill up your emergency fund and college savings if that applies. I like Scott's enthusiasm for improving and seizing opportunities. He always has his eyes open for learning. That even includes reading 100 books. If you had a different favorite Inspired Money moment, please let me know by posting a comment below. And for watching until the end, I want to send you an Inspired Money sticker. Go to inspiredmoney.fm/Andy, that's A-N-D-Y. Send me your name and address, and I will send you real mail. Thank you so much for joining me on this mission. Have an inspired week, and do something that scares you, because that is where the magic happens.